Hello, and welcome to our second quarter strategy review. We met on Monday, the 25th, and we covered topics which were kind of similar to what we've been covering. Federal Reserve activity, whether we'll see a lowering of interest rates, concern about stubborn inflation, and of course, all the international problems that we're having. We had a really good group with us. Number one, of course, was Len Skeena, Vice President, CEO of the firm. Number two, Bob Toomey, VP and Director of Research. Also, Scott Schill. Scott Schill is with us now as the Director of Longevity Law and Planning. And then we had two additional guests. Number one, we had Andy Luckel, who has been with us before. Andy is a portfolio manager with his own firm, Eagle Harbor Asset Management, and is always very, very good at bringing new things to the table, and that was certainly no exception yesterday. Also, Dave Hooper, portfolio manager with Kingview Partners, joined us as well. So without any further ado, we have got a lot of ground to cover, and we would like to turn it over now to Bob to talk about the U.S. equity markets.
Thanks a lot, Stan. So if you've been following our recent videos or some of the commentary that I've been putting out over the last several months, you know that we've been relatively positive on the outlook for stocks, and the market is sort of accommodating that view. And as you know, it's the stock market, as reflected in the S&P 500, is off to a very healthy start this year. It's up about 10% through yesterday. But I think the background for stocks remains positive for a number of reasons. First, the economy, we think, is going to continue to grow into 2024. A lot of the economists see it growing in the range of 2 to 2.5%. We think that is reasonable. Also, corporate profits have come in better than expected, and we expect corporate profits could grow in the high single digits or close to 10% this year. That's another support for stocks overall. And as Stan mentioned, the Federal Reserve policy, we believe, has become increasingly, let's call it, supportive. The Fed meeting last week was actually quite positive in the sense that the Fed admitted that inflation is not coming down as fast as they had expected, but despite that, they're still on track to reduce interest rates at least 3 times this year. So I think that was a very positive signal for stocks, and I think it supports the market, the stock market overall, more so than bonds, in fact. With respect to inflation, it is coming down, not quite as fast as we expected, but the trend is in the positive direction. And I think overall, market sentiment and valuation, while elevated, are still not at levels that I think are going to be deleterious or impede the ability of stocks to continue to go up based on stronger earnings as we move through the year. So right now, following the meeting, we continue to have overweights in the large cap stock area, commodities, particularly metals, and we're sort of neutral. We remain neutralish on small caps and international equities as it relates to our weightings in your portfolios. With that, I'm going to turn it over to Len to provide more information on international equities.
Thank you, Bob. The U.S. economy, frankly, is more solid than European economies, and it's been that way for a little while. We don't have anywhere near as much confidence in the European markets right now as we do in the U.S. markets. Their level of earnings, their level of growth is not as robust as the U.S., and we've been underweighting international markets for a little while. In fact, last quarter, we were underweighted. For the coming quarter, we're not only continuing to underweight them, but we're going to underweight them even a little bit more than before. And with that, Stan will now talk a little bit about REITs.
Thanks, Len. Talking about the REIT part of the portfolio, which has always been a strong part of the firm, we did continue to underweight REITs this quarter. We are concerned about large office buildings and large shopping centers for that matter as well. However, housing, personal housing has really been doing very well. And we actually have continued to add a portion of our portfolio into home builders. And home builders actually did extremely well during this quarter. And we are frankly expecting that to continue. Of course, the comments on interest rates, which we'll be getting into in a minute, will also have very strong underpinnings in the real estate, because although we are looking at some very, very good borrowing from the REITs at this point, some of those are going to have to start to roll over, and those rates could be higher, probably will be higher. So again, we do remain relatively conservative on the REIT portfolio. We still like the fact that we get the pass-through of all the dividends, so we get a higher rate of return. And again, by bolstering it with a specific investment in home builders, I don't want to break my arm patting us on the back, but that was a good move during this period of time. And again, we are continuing to move in that direction. With that, I would like to turn it back over to Len to talk about fixed income.
Thank you, Stan. The Fed has been about as transparent as possible in forecasting that they're going to cut interest rates, 3 times this year. We see no reason not to believe them. They are forecasting that about 3 rate cuts of 25 basis points each starting in June, and that's what we're forecasting at this point as well. Given that, we have slightly adjusted our allocation to fixed income up a bit in the long-term area, but we're not making significant changes overall. Our allocation has done quite well relative to the index of treasuries over the last several quarters. And so at this point, we don't see any compelling reason to make significant changes to our holdings at this time. Now, Bob will talk about other changes in our model.
Thanks, Len. So as Len mentioned, really, when you look at changes in the model following the meeting, there really weren't very many significant changes. There was really only one that I would really want to, in the equity area, that I would really want to point out, that within natural resources, we swapped out of a holding of the Spider Energy ETF, XLE, and we swapped those funds into the Spider Metals and Mining ETF, XME. So you will see that change in your portfolios. The reason why we did this is because we believe that, as we've stated a couple of times in this presentation, the economy, both here and overseas, is holding up better than many economists expected. That is supporting demand for industrial metals. Also, we think that the economy of China is probably in a position to start improving, although that might be modestly. China does have some significant problems with their economy right now, but they're doing a lot to start to stimulate that growth in their economy. That is positive for demand for metals. And also, as we mentioned before, there is developing a serious supply constraint for many industrial metals, particularly copper, nickel, molybdenum, and other metals of that type that are essential in industrial manufacturing of all types of products that we use every day in our lives. So I think it's the combination of those factors, decent economy and continued supply constraints, that we think are positive for the metal stocks overall and for their earnings and cash flows going forward. and we believe that it would be beneficial to have a slightly higher exposure to the metals area. Within other holdings, I would just continue to mention that within large cap stocks, our supplemental holding there is the Pacer Cash Cows ETF, which focuses on large, high quality companies that generate excessive free cash flow and generate high returns on equity. We think it continues to be a strong holding in the large cap space as an excellent offset to the S&P 500, which is heavily weighted towards technology stocks. Same goes for small cap stocks. We continue to hold the Avantis Small Cap Value ETF as a supplemental position in developing equities for exactly the same reason. We think that AVUV is the ticker, gives us greater exposure to higher companies with higher profits and higher free cash flows. Again, as an excellent complement to the Russell 2000 ETF, in which a fairly large proportion of those companies actually do not have profits. So, again, we're trying to find ways to increase value and quality within your portfolios by using those types of holdings. With that, I would like to turn it over to Scott, who's going to talk about some prospective changes in estate planning at the federal level.
Thanks, Bob. I want to talk a little bit about changes in the estate tax laws, which are always dynamic, and it's always a good idea to periodically review your estate plans. But particularly significant is the golden era of estate tax planning we're in right now, which was kicked off in 2017 by the Tax Cuts and Jobs Act, which doubled the federal estate and gift tax exemption. From then, it was about a little over 5 million to a little over 11 million. But currently, the federal estate and gift tax exemption is $13.61 million. The catch, it's set to sunset and expire at the end of 2025, where it'll go down to about between $6 and $7 million, probably around $6.8 million. So the time is now to see if we can take advantage of the exemption before it potentially sunsets at the end of 2025. What does that mean? That means strategic gifting, which can be trust-based planning or other opportunities. But because those types of plans take a while to implement, it's good to start the process now. Incidentally, in the state of Washington, we also have an estate tax that kicks in at a much lower rate at about $2.193 million. And there is no gift tax in the state of Washington or gift limit in the state of Washington. So strategic gifting, whether your estate hits the federal limit, which or not, is a strong area of consideration. So we encourage you to have your estate plan reviewed and make sure that we take advantage of this great opportunity that may be closing in the next year. Now I pass it on to Stan for some closing remarks.
Thanks, Scott. And thanks, Bob, as well. I would like to just comment that, as Bob mentioned, we haven't made a huge amount of changes in the portfolio again. We do look at things being relatively stable. And again, we just covered all of that, so I won't again. But we do always look at triggers at these quarterly meetings. They are very, very, we don't use them that often, but when we have used them, with the exception of one that Len pointed out, where we actually had triggers pulled right in succession of each other, most of all the others have actually been positive moves and things that we wanted to make sure that we did not miss if something strange happened. So what are we looking at this quarter? Well, we're looking at CPI, as we did before, Consumer Price Index. That was mentioned as one of the reasons why rates were not lowered at the last Fed meeting because of stubborn inflation. But again, looking at the CPI numbers themselves, we are continuing to say if the CPI numbers go down to the Fed hopes or expectations of 2.75, we would say that would be a positive move, and we would actually increase our holdings, especially in equities. On the other hand, we were concerned that it could go the other way. What happens if basically CPI went up on a monthly basis more than 0.85, which would be a negative, and we would probably cut back even further in our portfolios. The other trigger that we put in during this period of time does have to do with employment. Again, it's been mentioned there's a concern for employment. And again, looking back, although our unemployment rates, I should say, are still relatively good, once they start to move, they can move quickly. So looking at a 70-year history, we said if we saw unemployment go up to over 5%, then we would consider that also a negative trigger. But again, we're not looking at any really major changes. We continue to think the markets are not in terrible shape, as we talked about. And we hope that all of you enjoy a fabulous summer and will tune back in with us next quarter.